Most people think Warren Buffett hates bonds. They've heard me say that bonds are terrible long-term investments, that stocks beat bonds over any reasonable time period. That fixed income is a guaranteed way to lose purchasing power. And all of that is true. For young people building wealth, bonds are a mistake. But if you're over 60, the rules change. You're not building wealth anymore. You're preserving it and living off it. You can't afford a 50% drawdown right before you need to start withdrawals. You need stability. You need predictability. You need some portion of your portfolio that won't crash when stocks crash. That's where bonds come in. Not as a wealth building tool, as a wealth preservation and income tool. I'm Warren Buffett. I'm 94 years old. I've spent my life investing primarily in stocks, but even I own bonds. Berkshire holds over $130 billion in short-term treasury bills. And if I were 60 years old today managing my retirement portfolio, I'd absolutely own bonds. Not just any bonds. Specific types of bonds that make sense for retirees. Today I'm going to tell you about the only 3 types of bonds I'd trust if I were over 60 in 2026. These aren't complicated. These aren't exotic. They're simple, safe, liquid bonds that do exactly what retirees need them to do. Provide stability, generate income, preserve capital, and most importantly, be there when you need them during stock market crashes.
Before I reveal the 3 bonds, let me explain why bonds matter for investors over 60. Because understanding the purpose of bonds helps you use them correctly.
First, bonds reduce portfolio volatility. Stocks can drop 30 to 50% in severe bear markets. If your entire portfolio is stocks and the market crashes right when you start retirement, you're forced to sell shares at terrible prices. This permanently impairs your wealth. But if you have 30 or 40% in bonds, those bonds hold their value or even go up when stocks crash. You sell bonds to meet expenses. You leave stocks alone to recover. The sequence of returns protection is critical. Second, bonds provide predictable income. Stock dividends can be cut during recessions. Companies facing financial stress suspend dividends to preserve cash. But bond interest is contractually obligated. Unless the issuer goes bankrupt, you get your interest payment. For retirees who need steady income, this predictability matters. Third, bonds preserve capital. With high-quality bonds, you know you'll get your principal back at maturity. You might have price fluctuations before maturity if interest rates change. But if you hold to maturity, you get par value. This certainty is valuable when you can't afford permanent losses. Fourth, bonds provide liquidity for rebalancing. When stocks crash and bonds hold steady, you can sell bonds and buy stocks cheap. This forces you to buy low and sell high mechanically. It's a rebalancing strategy that improves long-term returns. Now, you might ask, Warren, if bonds are so important for retirees, why does Berkshire only own short-term treasury bills? Why not longer-term bonds? Great question. Berkshire is different from an individual retiree. We have permanent capital. We don't have withdrawal needs. We hold cash in short-term bills so we can act quickly when investment opportunities appear. If the market crashes and great businesses go on sale, we deploy our cash immediately. We're not managing for retirement income. We're managing for opportunistic capital deployment. But an individual retiree has different needs. You need more structure. You need bonds at various maturities to provide income and stability over time. So even though I run Berkshire one way, I'd manage a personal retirement portfolio differently. Now let me reveal the 3 types of bonds I'd own if I were over 60. Bond type 1 is short-term treasury bills and notes, maturity of 1 to 3 years. These are obligations of the U.S. government. They're backed by the full faith and credit of the United States. They're the safest investment on earth. Let me explain why short-term treasuries are perfect for the bond portion of a retiree's portfolio. First, they have essentially zero credit risk. The U.S. government has never defaulted on its debt and never will. Why? Because we issue debt in our own currency. We can always print dollars to pay our debts. This is different from corporations or state governments or foreign governments that borrow in currencies they don't control. The U.S. can always pay, period. For a retiree who can't afford to lose capital, this safety is priceless. Second, short-term treasuries have very low interest rate risk. When interest rates rise, bond prices fall. This relationship is mathematical, but the impact depends on duration. A 30-year bond might lose 30% of its value if rates rise 2%. A 2-year bond might lose 3%. The shorter the maturity, the less sensitive to rate changes. When you're over 60, you don't want to see your bonds lose 20 or 30% because rates rose. Short-term treasuries protect you from this. Third, short-term treasuries are perfectly liquid. You can sell them anytime at fair market prices. The bid-ask spread is tiny. If you need cash for an emergency or an opportunity, you can raise it immediately. No waiting, no penalty. Just sell and get your money in 2 days. This liquidity is important for peace of mind. Fourth, the yields are competitive with longer-term bonds right now. Normally, you get paid more to lend money for longer periods. The yield curve slopes upward. You might get 3% on a 2-year treasury and 4% on a 10-year treasury. That extra 1% compensates you for locking up your money longer and taking more interest rate risk. But right now, in 2025 and 2026, the yield curve is relatively flat. 2-year treasuries might yield 4.3%. 10-year treasuries might yield 4.4%. You're only giving up 10 basis points to stay short-term. That's nothing. Take the shorter maturity, less risk for almost the same yield. Fifth, short-term treasuries roll over quickly, allowing you to reinvest at higher rates if rates rise. If you buy a 10-year treasury at 4% and rates rise to 6%, you're stuck earning 4% for 10 years while new money earns 6%. But if you buy 2-year treasuries, they mature in 2 years, you reinvest at the new higher rates. This optionality is valuable in a rising rate environment. Now, how much of your bond allocation should be in short-term treasuries? If I were 60, I'd put 50% of my bond allocation here. If my overall portfolio is 60% stocks and 40% bonds, that means 20% of my total portfolio in short-term treasuries. On a $500,000 portfolio, that's $100,000 in short-term treasuries. I'd buy a ladder, meaning I'd buy treasuries maturing at different dates. $20,000 maturing in 6 months, $20,000 in 1 year, $20,000 in 18 months, $20,000 in 2 years, $20,000 in 30 months. Every 6 months, one matures. I reinvest it at the long end of the ladder. This creates regular cash flow and smooths out reinvestment risk. You're not investing everything at one point in time. You're spreading it out. This is called a bond ladder, and it's one of the smartest ways to manage fixed income. Bond type 2 is intermediate term municipal bonds from high-quality issuers. Maturity of 5 to 10 years.
These are bonds issued by state and local governments to fund infrastructure, schools, and public projects. The key feature of municipal bonds is that the interest is exempt from federal income tax.
For some people, it's also exempt from state income tax if you buy bonds from your home state. Let me explain why municipal bonds make sense for certain retirees over 60. First, the tax exemption can make them more attractive than treasuries for people in high tax brackets. Let's do the math. A 10-year treasury yields 4.4%. You pay federal tax on that interest. If you're in the 24% federal bracket, your after-tax yield is 3.34%. A 10-year high-quality municipal bond might yield 3.2% tax-free. That's equivalent to a taxable yield of 4.21% if you're in the 24% bracket. Not quite as good as the Treasury in this example, but if you're in the 32% bracket, a 3.2% muni is equivalent to a 4.7% taxable bond. Better than the Treasury. The higher your tax bracket, the more attractive munis become. Second, municipal bonds from high-quality issuers are very safe. Not as safe as treasuries, but close. General obligation bonds backed by the full taxing authority of a state or city are very unlikely to default. Essential service revenue bonds, like water and sewer bonds, are also very safe. People have to pay their water bills. These bonds keep paying even in recessions. The default rate on investment-grade munis is historically about 0.1%, very low. Third, municipal bonds provide diversification from federal government risk. Now, I don't think the U.S. government will default, but if you're worried about fiscal problems or political dysfunction in Washington, having some bonds issued by states gives you geographic and political diversification. Fourth, some municipal bonds have insurance. These are bonds where an insurance company guarantees payment if the issuer defaults. Insured munis are even safer than uninsured munis. The insurance adds a layer of protection. Now, there are risks with municipal bonds you need to understand. First, they have more credit risk than treasuries. States and cities can and do default. Detroit, Puerto Rico, Stockton, California. These were high-profile municipal bankruptcies. If you own bonds from an issuer that goes bankrupt, you can lose money. This is why you only buy high-quality munis. Stick with states and cities that have strong economies, good management, and low debt levels, AAA or AA-rated bonds only. Second, municipal bonds are less liquid than treasuries. If you need to sell before maturity, you might face a wider bid-ask spread. You might not get a fair price, especially for small odd lots. This is why you only invest money you can leave until maturity. Third, the tax exemption is only valuable if you're in a high enough tax bracket. If you're in the 10 or 12% federal bracket, munis don't make sense. The taxable equivalent yield is lower than treasuries. You're better off with treasuries. Munis are for people in the 22% bracket and higher. How much should you allocate to municipal bonds? If I were 60 and in the 24% tax bracket or higher, I'd put 30% of my bond allocation in intermediate term munis. On a $500,000 portfolio with 40% in bonds, that's 12% in munis. $60,000, I'd buy individual bonds, not muni bond funds. With individual bonds, you control maturity dates. You know exactly when you get your money back. With funds, you have no control. The fund manager buys and sells bonds constantly. You're subject to interest rate risk with no maturity date. Buy individual bonds. Ladder them like the treasuries. 10,000 maturing in 5 years, 10,000 in 6 years, 10,000 in 7 years, 10,000 in 8 years, 10,000 in 9 years, 10,000 in 10 years. Every year, one matures. Reinvest at the long end, regular cash flow, predictable income. Now, which municipal bonds specifically? Stick with large, well-managed states. California general obligation bonds, New York general obligation bonds, Texas. These states have diverse economies and large tax bases. They're not going bankrupt. Also consider essential service revenue bonds from major cities, New York City water and sewer bonds, Los Angeles municipal bonds, Chicago O'Hare Airport bonds. These revenue streams are stable and critical. People pay these bills even in recessions. Avoid bonds from struggling cities or states with pension problems. Illinois, New Jersey. These states have serious fiscal challenges. The bonds might be okay, but why take the risk? Stick with the highest quality. Bond type 3 is short duration corporate bonds from blue chip companies. Maturity of 2 to 5 years. These are bonds issued by large, stable, profitable corporations to fund operations and growth. Let me explain why short duration investment grade corporate bonds have a place in a retiree's portfolio. First, they offer higher yields than treasuries. A 2-year treasury might yield 4.3%. A 2-year Apple corporate bond might yield 4.7%. That extra 40 basis points is your compensation for credit risk. Over a portfolio of $100,000 in corporates, that's $400 extra per year. Not huge, but not nothing either. Over 10 years, it adds up. Second, the credit risk is minimal if you stick with blue chip companies. Apple has $160 billion in cash and securities on the balance sheet. They generate $100 billion in free cash flow annually. They're not defaulting on their bonds, ever. Same with Microsoft, Johnson & Johnson, Berkshire Hathaway bonds, Coca-Cola. These are among the strongest companies on earth. The risk of default is essentially zero. Third, short duration corporate bonds have low interest rate risk. Because they mature in 2 to 5 years, they They don't get crushed when rates rise. A 5-year bond might lose 5 to 7% if rates rise 1%. Painful but not devastating. And if you hold a maturity, you get par value back regardless of what happened to prices in between. Fourth, corporate bonds provide diversification across different issuers and industries. You can own bonds from technology companies, healthcare companies, consumer companies, financial companies. This sector diversification reduces concentration risk. Now, the risks with corporate bonds. First, they do have credit risk. Companies can default. It's rare with investment-grade bonds, but it happens. During the 2008 financial crisis, Lehman Brothers bondholders lost everything. General Motors bondholders took big losses in bankruptcy. This is why you only buy bonds from the highest quality companies with fortress balance sheets. Second, corporate bonds are less liquid than treasuries. Selling before maturity might require accepting a discount. This is especially true for small corporate bond positions. You might have to sell at unfavorable prices if you need cash urgently. Third, corporate bonds are taxable. Unlike munis, you pay federal and state income tax on corporate bond interest. If you're in a high bracket, this reduces the after-tax return. How much should you allocate to corporate bonds? If I were 60, I'd put 20% of my bond allocation in short-duration investment-grade corporates. On a $500,000 portfolio with 40% bonds, that's 8% in corporates, $40,000. I'd buy individual bonds from 5 to 7 different companies to diversify. 8,000 in Apple bonds maturing in 3 years, 8,000 in Microsoft bonds maturing in 2 years, 8,000 in Johnson & Johnson bonds maturing in 4 years, 8,000 in Coca-Cola bonds maturing in 3 years, 8,000 in Berkshire bonds maturing in 5 years. Different companies, different maturities. This creates diversification and a natural ladder. Now let me put this all together and show you exactly how a 60-year-old should structure their bond allocation. Total portfolio is $500,000. Stock allocation is 60%, $300,000. Bond allocation is 40%, $200,000. Within the $200,000 bond allocation, short-term treasuries, 1 to 3 year ladder, $100,000, 50% of bonds. Intermediate term municipal bonds, 5 to 10 year ladder, $60,000, 30% of bonds. Short duration corporate bonds, 2 to 5 year ladder, $40,000, 20% of bonds. This gives you a diversified bond portfolio with low credit risk, low interest rate risk, tax efficiency, and predictable income. Let's calculate the income. Short-term treasuries at 4.3% yield, $4,300 annually. Municipal bonds at 3.2%, tax-free yield, $1,920 annually. Corporate bonds at 4.7% yield, $1,880 annually. Total annual bond income is $8,100. That's a 4.05% yield on your $200,000 bond allocation. Not bad. Plus the income is fairly stable and predictable. Now let me show you what this bond allocation does during different market environments. Scenario 1, normal environment with stable rates. You're 65, retired. You have this bond portfolio. Stocks are doing fine, growing at 8%. Bonds are yielding 4%. You reinvest bond interest for the first few years. Your bond portfolio stays at $200,000. Your stock portfolio grows from $300,000 to about $400,000 over 5 years. Total portfolio is $600,000. You're pleased. The bonds did their job, provided stability and income. Scenario 2, rising interest rate environment. You're 67. Interest rates rise from 4% to 6% over 3 years. Your bond prices fall. Short-term treasuries lose about 4%. Municipal bonds lose about 12%. Corporate bonds lose about 8%. Your $200,000 bond portfolio drops to about $182,000. You're worried. But here's what actually happened. Every time a bond matured, you reinvested at higher rates. Treasuries that were yielding 4.3% are now yielding 6.3%. Munis that were yielding 3.2% are now yielding 5%. Corporates that were yielding 4.7% are now yielding 6.7%. Your income is rising dramatically. Within 3 years, as all your bonds roll over, your annual income goes from $8,000 to $12,000. That's a 50% increase. And the bonds that fell in price, they'll recover as they approach maturity. If you bought a bond for $100 and it fell to $92 when rates rose, but it matures at $100, you'll get that $8 back. You don't have a permanent loss unless you sell before maturity. The temporary price drop doesn't matter. This is why you only invest bond money you can leave until maturity. Scenario 3, stock market crash. You're 70. The stock market crashes 40%. Your $300,000 in stocks drops to $180,000. Total portfolio is $380,000. You're panicked. You need $35,000 per year to live. Do you sell stocks at a 40% loss? No, you sell bonds. Your bonds held their value or went up slightly because when stocks crash, money flows to safety. People buy treasuries. Bond prices rise. Your $200,000 in bonds is now worth $210,000. You sell $35,000 of bonds to meet your spending needs. Your stocks stay invested at $180,000. You don't lock in losses. Over the next 3 years, stocks recover. Your $180,000 grows back to $300,000. Your bond portfolio, after selling $35,000 per year for 3 years, is down to about $105,000. But your total portfolio is back to $405,000. You survived the crash because you had bonds to sell instead of stocks. This is the whole point of bonds for retirees. Scenario 4, deflation and recession. You're 72, the economy enters a deep recession, deflation sets in, interest rates fall to near zero, your bond prices soar. Long-term bonds increase in value when rates fall. Your $200,000 in bonds might be worth $220,000. Your stocks struggle in the recession, falling from $300,000 to $250,000. But your bonds cushion the blow. Total portfolio is $470,000. Not great, but much better than if you'd been 100% stocks. And your bond income stays stable even though stock dividends are being cut. These scenarios show why bonds matter for retirees. They provide stability in rising rate environments. They provide liquidity in stock crashes. They preserve capital in recessions. They're not exciting. They're not going to make you rich, but they're going to keep you from going broke. That's their job. Now let me address common objections to bonds. Objection 1, bonds lose money to inflation. A bond yielding 4% when inflation is 3% only gives you 1% real return. You're barely keeping up. Yes, that's true. But what's the alternative? Keeping money in stocks and watching it drop 40% right when you need it? That's worse than earning 1% real return. Bonds aren't meant to build wealth. They're meant to preserve it and provide stability. For wealth building, you still have 60% in stocks. Objection 2, I can get higher yields from junk bonds or emerging market bonds. Why settle for 4% when I can get 8%? Because that extra 4% comes with massive risk. Junk bonds default. Emerging market bonds lose value when currencies crash. When you're over 60, you can't afford to chase yield into risky bonds. Stick with high quality. Accept lower yields for safety. Objection 3, bond funds are easier than buying individual bonds. Why not just buy a total bond market fund? Because bond funds have no maturity date. You're subject to interest rate risk forever. If rates rise and stay high, your bond fund stays underwater. But if you own individual bonds, you can hold to maturity and get par value back. You have certainty. Plus, bond funds charge fees. Even low-cost bond funds charge 0.05 to 0.1%. With individual bonds, you pay nothing once you own them. No ongoing fees. Objection 4, I don't know how to buy individual bonds. It seems complicated. It's actually simple. You open a brokerage account at Fidelity, Schwab, or Vanguard. You go to the bond section. You search for treasury bonds or municipal bonds or corporate bonds. You see a list with maturity dates and yields. You buy the ones you want. It's like buying stocks, but even easier because bonds are less volatile. The brokerage holds the bonds for you. You get interest payments automatically. At maturity, you get par value back automatically. It takes maybe 30 minutes to build a bond ladder once you understand the process. Now, let me give you step-by-step instructions for building this 3-bond portfolio. Step 1, open a brokerage account if you don't have one. I recommend Fidelity or Schwab. Both have excellent bond platforms. Step 2, fund the account with the amount you want to allocate to bonds. Let's say $200,000. Step 3, decide your allocation, 50% treasuries, 30% munis, 20% corporates. That's $100,000, $60,000, $40,000. Step 4, build the treasury ladder, go to the treasury bond section, search for bills and notes maturing at 6-month intervals over the next 3 years. Buy 20,000 maturing in 6 months, 6 months later, 6 months later, etc. Place the orders. Step 5, build the municipal bond ladder. This is harder because you need to find high-quality munis at the right maturities. Search for AAA or AA-rated general obligation bonds from large states, or AA-rated essential service revenue bonds from major cities. Buy 10,000 maturing each year from 5 years out to 10 years out. You might have to search across different issuers to find bonds at each maturity. That's fine. Diversification is good. Step 6, build the corporate bond ladder. Search for bonds from blue chip companies. Apple, Microsoft, Johnson & Johnson, Coca-Cola, Berkshire, Visa, Procter & Gamble. These companies all have bonds outstanding. Find bonds maturing in 2 to 5 years. Buy 8,000 of 5 different companies at different maturities. Step 7, set up automatic reinvestment of interest payments. Most brokerages let you automatically reinvest bond interest into a money market fund. Do this, the interest accumulates and can be used for living expenses or rebalancing. Step 8, calendar the maturity dates. Put reminders on your calendar for when bonds mature. When a bond matures, you'll get the proceeds in cash. Decide whether to reinvest in a new bond at the long end of the ladder or use the cash for expenses or rebalancing. Step 9, rebalance annually between stocks and bonds. Once a year, check your allocation. If stocks have done well, and you're now 70% stocks, 30% bonds, rebalance. Sell some stocks, buy more bonds. If stocks crashed and you're now 50% stocks, 50% bonds, rebalance the other way. Sell bonds, buy stocks. This forces you to buy low and sell high mechanically. Step 10, never sell bonds before maturity unless you have to. Let them mature. Collect the par value, reinvest or spend as needed. Selling early creates unnecessary losses if rates have risen. Now let me address a critical question. How should your bond allocation change as you age? At 60, 40% bonds might be right, but what about at 70, 80, 90? Here's my recommendation. Age 60 to 65, 40% bonds. You're recently retired or about to retire. You need stability as you transition from working to living off savings. Age 65 to 75, 45 to 50% bonds. You're in early retirement. Sequence of returns risk is highest in the first decade. More bonds protect you. Age 75 to 85, 50 to 55% bonds. You're in mid to late retirement. You have less time horizon. More bonds make sense. Age 85 plus, 55 to 60% bonds. You're in late retirement. Preservation matters more than growth. Bonds provide stability and simplicity. This gradual shift toward more bonds as you age is sensible. Your time horizon shortens. Your ability to recover from losses declines. Your need for income and stability increases. Bonds provide all of that. Now let me tell you what not to do with bonds. Don't buy long-term bonds. Anything over 10 years, maturity has too much interest rate risk. A 30-year bond can lose 30 to 40% if rates rise 2%. You don't need that volatility. Stick with short to intermediate bonds. Don't buy junk bonds for higher yield. High yield bonds default. When you're over 60, you can't afford defaults. Stick with investment grade bonds only. Don't buy bond funds. Individual bonds give you control over maturity dates and eliminate ongoing fees. Do the work to buy individual bonds. Don't buy floating rate bonds unless you understand them. These bonds have rates that adjust based on an index. They can be complex. Stick with fixed rate bonds where you know exactly what you're getting. Don't buy foreign bonds. Currency risk can wipe out your returns. Stick with you. bonds denominated in dollars. Let me close with this. If you're over 60, bonds are not optional. They're essential. Not for building wealth, for preserving it, for providing stability when stocks crash, for generating predictable income, for giving you peace of mind. The three types of bonds I'd own are simple: short-term treasuries for safety and liquidity, intermediate-term municipal bonds for tax-advantaged income, short-duration corporate bonds from blue chips for slightly higher yields. Together, these three types create a diversified, low-risk, income-producing bond portfolio that does exactly what retirees need. Build a ladder, hold to maturity, collect your interest, sleep well at night knowing your bonds are safe and working for you. This isn't exciting. This isn't going to make you rich, but it's going to protect you from going broke. And when you're over 60, that's what matters. Now, let me give you detailed examples of actual bonds you could buy today to implement this strategy. Because knowing the theory is one thing, knowing exactly which bonds to buy is another. For the short-term treasury portion, $100,000 total, here's a specific ladder you could build today. 20,000 in 6-month treasury bills currently yielding about 4.2%. You can buy these through treasurydirect.gov or through your brokerage. They mature in 6 months. You get your 20,000 back plus about 420 in interest. 20,000 in 1-year treasury notes yielding about 4.3%. These mature in 12 months. You get 860 in interest. 20,000 in 18-month treasury notes yielding about 4.35%, maturity in 18 months, interest of 870. 20,000 in 2-year treasury notes yielding about 4.4%. 20,000 in 30-month treasury notes yielding about 4.45%. 20,000 in 3-year treasury notes yielding about 4.5%. This ladder of 100,000 across 6 positions gives you approximately $4,300 in annual interest. Every 6 months, 20,000 matures. You reinvest it at the long end of the ladder. In 3 years, you're in a steady state where every 6 months you're reinvesting 20,000. This creates a predictable rhythm and protects you from reinvesting everything at one bad moment in time. For the intermediate municipal bond portion, 60,000 total. Here's a specific ladder. 10,000 in California, general obligation bonds maturing in 2030, currently yielding about 3.1% tax-free, rated AA. Interest of $310 annually. 10,000 in New York, general obligation bonds maturing in 2031, yielding about 3.15% tax-free, rated AA. Interest of $315 annually. 10,000 in Texas, general obligation bonds maturing in 2032, yielding about 3% tax-free, rated AAA. Interest of $300 annually. 10,000 in Los Angeles, Department of Water and Power Revenue bonds maturing in 2033, yielding about 3.2% tax-free, rated AA. These are essential service bonds backed by water bills. Very safe. Interest of $320 annually. 10,000 in New York City, Municipal Water Finance Authority bonds maturing in 2034, yielding about 3.25% tax-free, rated AA+, interest of $325 annually. 10,000 in Chicago, O'Hare International Airport revenue bonds maturing in 2035, yielding about 3.3% tax-free. Rated A+, these are backed by airport fees and revenues, interest of $330 annually. Total annual income from this muni ladder is $1,900 tax-free. If you're in the 24% federal bracket, that's equivalent to $2,500 in taxable income. If you're in the 32% bracket, equivalent to $2,800 in taxable income. The tax savings matter. For the corporate bond portion, $40,000 total. Here's a specific ladder. 8,000 in Apple Inc. bonds maturing in 2028, yielding about 4.6%. Rated AA+. Interest of $368 annually. These are backed by Apple's fortress balance sheet and $100 billion in annual free cash flow. 8,000 in Microsoft Corporation bonds maturing in 2029, yielding about 4.65%, rated AAA. Interest of $372 annually. Microsoft has over $100 billion in cash and massive recurring revenue from cloud services. 8,000 in Johnson & Johnson bonds maturing in 2030, yielding about 4.7%. Rated AAA, interest of $376 annually. Johnson & Johnson is one of only 2 U.S. companies with AAA ratings. Impeccable credit quality. 8,000 in Visa Inc. bonds maturing in 2027, yielding about 4.55%. Rated AA-, interest of $364 annually. Visa generates massive cash flow with minimal capital requirements. 8,000 in Berkshire Hathaway bonds maturing in 2028, yielding about 4.65%. Rated AA+. Interest of $372 annually. These are bonds from the company I run. I know our financial strength. Total annual income from corporate bonds is $1,852. This gives you a complete, specific bond portfolio. 100,000 in treasuries yielding $4,300, 60,000 in munis yielding $1,900 tax-free, 40,000 in corporates yielding $1,852. Total bond portfolio of 200,000 generating $8,152 in annual income. That's a 4.08% yield. Plus, the income is predictable and the principal is safe. Now, let me address specific questions people ask about implementing this strategy. Question 1, should I buy bonds directly from the issuer or through a broker? For treasuries, you can buy directly through treasurydirect.gov. It's free, no commissions. But the website is clunky and outdated. It's easier to buy through a broker like Fidelity or Schwab. They charge no commission on treasury purchases. For municipal and corporate bonds, you have to buy through a broker. There's no direct purchase option. Fidelity and Schwab have good bond platforms with search tools and pricing information. Question 2, how do I know if I'm getting a fair price on a bond? Bonds trade in an over-the-counter market, not on an exchange like stocks. Pricing is less transparent. Here's what to do. Check the yield. Compare the yield on the bond you're considering to similar bonds with the same credit quality and maturity. If a AA-rated muni maturing in 2032 is yielding 3.1% and you're being offered a similar bond at 2.8%, you're overpaying. Look for bonds yielding at or above the market rate for that quality and maturity. Also, buy larger positions when possible. 10,000 of a bond gets you a better price than 2,000. The market is more liquid for larger trades. Question 3. What happens if interest rates fall after I buy bonds? Your bonds will increase in price. If you bought a bond at par, $100, yielding 4%, and rates fall, so new bonds yield 3%, your bond becomes more valuable. It might trade at 107 or 108. You could sell it for a profit. But I don't recommend selling. Just hold to maturity. The price appreciation is nice, but not the reason you own bonds. You own them for stability and income. Question 4, what happens if I need to sell a bond before maturity? You can sell anytime. The broker will find a buyer and you'll get the current market price. But you might lose money if rates have risen since you bought. If you paid $100 for a bond and rates rose, so it's now worth $94, selling locks in a $6 loss. This is why you only invest money in bonds that you can leave until maturity. Have a separate emergency fund in cash so you never have to sell bonds early. Question 5, should I use a bond ladder or just buy bonds all at once? Ladder. Absolutely ladder. Buying all your bonds at once means if you buy when rates are low, you're locked in at low rates for years. A ladder spreads your purchases over time. Some bonds are bought when rates are low, some when rates are high. You average out, plus a ladder creates regular maturities. Every 6 months or every year, you're getting principal back. This creates flexibility. You can reinvest or spend as circumstances require. Question 6, how often should I rebalance between stocks and bonds? Once a year is enough. Some people rebalance quarterly. That's too frequent. You're trading too much. Once a year, check your allocation. If it's drifted more than 5 percentage points from target, rebalance. If your target is 60% stocks, 40% bonds, and you're at 66% stocks, 34% bonds, because stocks did well, rebalance. Sell 6% of your portfolio in stocks, buy 6% in bonds, get back to 60-40. This discipline forces you to buy low and sell high. Question 7, should I keep bonds in my taxable account or retirement account? It depends on the type of bond. Municipal bonds should always go in taxable accounts. Why? Because muni interest is already tax-free. Putting them in a retirement account wastes the tax benefit. When you withdraw from a traditional IRA, everything is taxed as ordinary income. You lose the tax-free advantage. So munis in taxable accounts only. Treasuries and corporate bonds can go in either account. If you have limited retirement account space, prioritize stocks in retirement accounts because stock gains are taxed at capital gains rates in taxable accounts lower than ordinary income. Put bonds in taxable accounts. But if you have plenty of retirement space, it doesn't matter much. Question 8, what about I-bonds or TIPS? Should I own those instead? I-bonds are savings bonds that pay a fixed rate plus an inflation adjustment. They're fine for small amounts. But you can only buy $10,000 per year per person through Treasury Direct. Not enough to build a meaningful bond portfolio. They also have restrictions. You can't redeem them for 1 year. If you redeem before 5 years, you lose the last 3 months of interest. They're okay as part of an emergency fund, but not as the core of a bond portfolio. TIPS are Treasury inflation-protected securities. The principal adjusts with inflation. If inflation is 3%, your bond's principal increases by 3%. Then you get interest on the new higher principal. TIPS protect against inflation, but right now TIPS yields are very low, around 1.5 to 2% real yield. Regular treasuries yield 4 to 4.5% nominal. Unless you expect inflation above 2.5 to 3% for the entire holding period, regular treasuries are better. I'd skip TIPS and stick with regular treasuries. Question 9, what about agency bonds like Fannie Mae or Freddie Mac? Agency bonds are issued by government-sponsored enterprises. They're not backed by the full faith and credit of the U.S. government, but there's an implicit guarantee. They yield slightly more than treasuries, maybe 10 to 20 basis points more. They're fine. Safer than corporate bonds, higher yield than treasuries. If you want to replace some of your corporate bond allocation with agency bonds, that's reasonable. Buy short-term agency bonds, 2 to 5 years, from Fannie Mae or Freddie Mac. Question 10, what if I already own bond funds? Should I sell them and buy individual bonds? That depends. If you own low-cost bond funds like Vanguard Total Bond Market or Vanguard Intermediate Term Treasury, those are fine for small portfolios. If you have less than $100,000 in bonds, individual bonds might not be practical. The minimum purchase is usually $1,000 to $5,000 per bond. Building a diversified ladder is hard with small amounts. Keep the bond funds. But if you have $100,000 or more in bonds, I'd transition to individual bonds over time. As your bond funds pay interest and you add new money, use it to buy individual bonds. Gradually build out your ladder. Don't sell the bond fund all at once, especially if rates have risen and the fund is down. Just stop adding to it and build the individual bond ladder alongside. Eventually, the individual bonds will dominate and you can sell the remaining bond fund. Now, let me walk you through the emotional and psychological aspects of owning bonds, because bonds are boring. They don't give you the excitement of stocks doubling. They just sit there generating interest. And when you're watching your neighbor brag about his stocks going up 30% while your bonds earn 4%, you might feel like you're missing out. This is a test. The whole point of bonds is that they're boring and predictable. That's what you want when you're over 60. You're not trying to get rich from bonds. You're trying to preserve wealth and generate income. The excitement comes from knowing you can sleep well at night because your portfolio is balanced and resilient. When the next crash comes, and it will come, you'll be glad you have boring bonds instead of exciting stocks that are down 40%. Another psychological challenge is watching bond prices decline when rates rise. You check your account. You see that your bonds are down 5%. You feel like you made a mistake. You wonder if you should sell. Here's what you remember. If you're holding to maturity, the price decline is temporary and irrelevant. You're getting the same interest payments. At maturity, you get par value back. The price fluctuation is meaningless noise. Ignore it. In fact, You should be happy when bond prices fall because rates rose. Why? Because when your bonds mature, you reinvest at higher rates. Your income goes up. The price decline is actually good for you long term if you're reinvesting. The final psychological challenge is the temptation to chase yield. You see junk bonds yielding 8%, or emerging market bonds yielding 7%, or preferred stocks yielding 6%. You think, why am I settling for 4% on treasuries when I could get 8% on junk bonds? This is how retirees get in trouble. They chase yield into risky assets. Then those assets default or crash and they lose their principal. Getting 8% yield is meaningless if you lose 40% of your capital. You're net negative. With high quality bonds at 4%, you might not get rich, but you don't lose your capital either. Stay disciplined, resist the temptation, stick with the 3 bond types I outlined. Now let me give you a final comprehensive example showing exactly how this 3 bond portfolio performs over a 20-year retirement. You're 65 with 500,000. 60% stocks, 300,000. 40% bonds, 200,000. Bonds are split, 100,000. Treasuries, 60,000 munis, 40,000 corporates. You need 40,000 per year to live on. Social Security provides 25,000. You need 15,000 from your portfolio. Your bonds generate about 8,100 in annual interest. You take that as income, you need another 6,900. You sell small amounts of stocks or bonds to raise it. Year 1, portfolio value is 500,000. You take 15,000. Stocks grow 8%. Bonds yield 4%. End of year 1, portfolio is 516,000. Year 2, you take 15,000. Markets are good. End of year 2, 534,000. Year 3, stock market crashes 40%. Your stocks drop from 320,000 to 192,000. Your bonds stay stable at 200,000. Total portfolio is 392,000. You're scared, but you don't panic. You sell bonds to meet your spending needs instead of selling stocks. Year 4, stocks start recovering. Year 5, stocks are back to previous highs. Your portfolio is 430,000. You weathered the crash. Years 6 through 15, markets are good on average. Some years up, some years down, but trending higher. You keep taking 15,000 per year. Your portfolio grows to about 600,000 by year 15. At age 80, you increase your bond allocation to 55% because you want more stability. You sell some stocks, buy more bonds. Years 16 through 20, you're 80 to 85. Markets are volatile, but your bond-heavy portfolio is stable. You keep taking 15,000 per year plus bond interest. At age 85, your portfolio is still worth about 550,000. You've taken 15,000 per year for 20 years, 300,000 total. Your portfolio is larger than when you started. You never ran out of money. You maintained your standard of living. You left an inheritance for your heirs. This is the power of a balanced portfolio with the right bonds. The bonds provided stability in the crash. They generated predictable income every year. They gave you the confidence to hold your stocks through volatility. You didn't panic because you had bonds to fall back on. This is exactly what retirees need. Start building this bond portfolio today if you haven't already. Figure out your allocation. Open a brokerage account. Buy individual bonds. Build your ladders. Then forget about them and let them do their job. Your portfolio will be more stable, your income more predictable, your retirement more secure. That's the power of the right bonds used the right way. Now let me address one final critical topic that most people misunderstand about bonds. The relationship between bond duration, interest rate risk, and total return. This is technical but important. Understanding this will help you make better decisions. Duration is a measure of how sensitive a bond's price is to interest rate changes. It's expressed in years, but it's not the same as maturity. A bond with a duration of 5 means that if interest rates rise 1%, the bond's price falls approximately 5%. If interest rates fall 1%, the price rises approximately 5%. Short-term bonds have low duration. A 2-year treasury might have a duration of 1.9. If rates rise 1%, it loses 1.9%, not much. Intermediate bonds have moderate duration. A 10-year municipal bond might have a duration of 7. If rates rise 1%, it loses 7%, more painful. Long-term bonds have high duration. A 30-year treasury might have a duration of 20. If rates rise 1%, it loses 20%. Devastating. This is why I recommend short to intermediate bonds for retirees. Keep duration low to moderate. Minimize interest rate risk. Now, here's what people get wrong. They look at yields and think, why would I buy a 2-year treasury at 4.3% when I can buy a 30-year treasury at 4.6%? I get an extra 30 basis points over 30 years. That adds up. The mistake is not accounting for interest rate risk. Yes, the 30-year bond pays more, but if rates rise even modestly, say 1% over the next few years, you'll lose 20% of your capital. That wipes out 5 years of the extra yield you were getting. Meanwhile, the 2-year bond only loses 2%. You recover quickly. The total return on the short-term bond ends up being higher even though the yield was lower. This is counterintuitive but true. Lower yield can mean higher total return if you avoid the interest rate risk. Let me show you the math with a specific example. You have $100,000 to invest. Option A, buy 2-year treasuries yielding 4.3%. Option B, buy 30-year treasuries yielding 4.6%. Seems like option B is better. Extra 30 basis points, $300 per year. Over 10 years, that's $3,000 extra. But let's say rates rise 1% over the next 2 years. Option A, the 2-year bonds, loses about 2% in year 1. Your $100,000 becomes $98,000. But you earn $4.3 in interest. Net, you're at $102,300. In year 2, same thing. Small price loss, good interest. After 2 years, the bonds mature. You get $100,000 back, plus you've collected $8,600 in interest. You reinvest at the new higher rate of 5.3%. Over the next 8 years, you're earning $5,300 per year in interest, total after 10 years. Principal of $100,000 plus interest collected of about $90,000. Option B, the 30-year bonds, loses about 20% in year 1 when rates rise. Your $100,000 becomes $80,000. You earn $4,600 in interest. Net, you're at $84,600. The bond doesn't mature for 28 more years. You're stuck. You can't reinvest at higher rates. Over 10 years, you collect $46,000 in interest. Your bond is still worth about $80,000 because rates are higher. Total after 10 years, bond value of $80,000 plus interest collected of $46,000 equals $126,000. Option A ended at $190,000. Option B ended at $126,000. The short-term bond, despite lower yield, generated $64,000 more wealth. Why? Because it avoided interest rate risk and allowed reinvestment at higher rates. This is why I emphasize short-term bonds for retirees. Lower duration, lower risk, often better total returns. Now let me talk about bond credit ratings and what they actually mean. Bonds are rated by agencies like Moody's, S&P, and Fitch. The ratings indicate credit quality, the likelihood the issuer will pay interest and principal as promised. Here's the rating scale. AAA or AAA is the highest rating. Extremely strong capacity to pay. Minimal risk. Only about 2 companies in the U.S. have this rating currently, Microsoft and Johnson & Johnson. AA or AA is very strong capacity to pay. Very low risk. Companies like Apple, Google parent Alphabet, Berkshire Hathaway. A or A is strong capacity to pay. Low risk, but slightly more vulnerable to economic conditions. BBB or BA is adequate capacity to pay, but more subject to economic conditions. This is the lowest investment grade rating. BB or BA and below is speculative. These are junk bonds. Significant credit risk should be avoided by retirees. For the bond portfolio, I've recommended stick with A-rated or better. For treasuries, they're considered AAA, even though they're not formally rated, backed by the government. For municipal bonds, buy AA or AAA rated bonds only. maybe A-rated if it's an essential service revenue bond from a major city. For corporate bonds, buy A-rated or better. Apple, Microsoft, Johnson & Johnson, Visa, Berkshire, these are all AA or AAA rated. The rating tells you default risk. AAA bonds virtually never default. A-rated bonds default less than 0.2% historically. BBB bonds default about 0.5%. BB bonds default several percent. Junk bonds default 10 to 15% during recessions. You cannot afford defaults when you're over 60. Stick with investment grade A or better. Let me also address the question of callable bonds versus non-callable bonds. A callable bond gives the issuer the right to redeem the bond before maturity at a specified price. Why would an issuer call a bond? If interest rates fall and they can refinance at a lower rate, imagine you issue a bond at 6%, rates fall to 3%. You call the bond, pay off the bondholders, and issue new bonds at 3%. You save 3% in annual interest. This is bad for bondholders. You thought you'd earn 6% for 10 years, but after 3 years, the bond is called. You get your principal back, but now you have to reinvest at 3%. You lose the high yield. This is call risk. For retirees, I generally prefer non-callable bonds. You want certainty. You want to know you'll get that yield for the entire maturity. With callable bonds, you have uncertainty. They might be called early. You might have to reinvest at lower rates. Now, callable bonds pay slightly higher yields to compensate for call risk. Maybe you get an extra 20 or 30 basis points. For some people, that's worth it, but I prefer the certainty of non-callable bonds. When you're building your bond ladder, check if bonds are callable. If they are, make sure the call protection is sufficient. Some bonds are non-callable for the first 5 years, then callable after. That might be acceptable. But bonds that are immediately callable should be avoided unless the yield premium is substantial. Now, let me give you specific guidance on how to research bonds before buying them. This is where many people get intimidated, but it's simpler than you think. For Treasury bonds, there's no research needed. They're all backed by the government. They're all AAA quality. Just find the maturity and yield you want and buy. For municipal bonds, here's what to check. 1, the credit rating. AA or better preferred. AAA ideal. 2, the issuer's financial health. Go to the issuer's website. Many states and cities publish annual financial reports. Look at debt levels, pension obligations, tax revenues. Are they stable or declining? Strong states have diverse economies, growing tax bases, and manageable debt. Weak states have one industry economies, declining populations, and massive unfunded pensions. 3, the type of bond. General obligation bonds backed by taxing authority are safer than revenue bonds backed by a specific project. Essential service revenue. Bonds like water and sewer are very safe because people have to pay these bills. 4, insurance. Some munis are insured. If the bond has insurance, there's a third party guaranteeing payment if the issuer defaults. Insured bonds are safer. For corporate bonds, here's what to check. 1, the credit rating. A or better. 2, the company's financial strength. Look at the balance sheet. How much debt do they have? How much cash? What's the debt to EBITDA ratio? Under 3 times is healthy. Over 5 times is concerning. 3, free cash flow. Does the company generate enough cash to cover interest payments many times over? Interest coverage ratio should be at least 5 times. 4, the business model. Is this a stable business with predictable cash flows, or a cyclical business that struggles in recessions? Stick with stable businesses. Let me walk you through a specific example of evaluating a corporate bond. Let's say you're considering buying an $8,000 position in Coca-Cola bonds maturing in 2030, yielding 4.8%. Here's how I'd analyze it. First, check the rating. Coca-Cola is rated A+ by S&P. That's investment grade. Good. Second, look at the financials. Coca-Cola has about $37 billion in total debt. They generate about $10 billion in annual free cash flow. Debt to free cash flow is 3.7 times. Manageable. They generate about $15 billion in operating income. Interest expenses about $1.5 billion. Interest coverage ratio is 10 times. Excellent. Third, assess the business. Coca-Cola sells beverages. People drink beverages in good times and bad. It's non-cyclical. They have a 139-year history. They've survived every economic challenge imaginable. The business model is solid. Fourth, check liquidity. Coca-Cola bonds trade actively. If you needed to sell early, you'd get a fair price. Fifth, compare the yield to similar bonds. Other A-rated corporate bonds with similar maturity yield about 4.6 to 4.9%. Coca-Cola at 4.8% is right in line. Fair price. Conclusion. This is a good bond to buy. High credit quality, strong financials, stable business, fair yield, liquid. I'd include it in the corporate bond portion of the ladder. This evaluation process takes maybe 15 minutes per bond. Do it for each bond you're considering. Make sure you understand what you're buying. Finally, let me give you a resource list for bond investing. Where to learn more, where to buy bonds, where to get information. For buying bonds, Fidelity and Schwab both have excellent bond platforms. Easy to search, good pricing, no commissions on treasuries. Vanguard also has a bond platform, but it's less user-friendly. For treasury bonds, specifically, treasurydirect.gov lets you buy directly from the government. Free, but the website is dated. For bond research and data, EMMA, the Electronic Municipal Market Access System, has information on every municipal bond. Free. You can look up bond details, financial statements of issuers, historical prices. FINRA, the Financial Industry Regulatory Authority, has a bond center where you can look up corporate bond prices and yields. Also free. For learning about bonds, I recommend the book, The Bond Book by Annette Thau. It's comprehensive and accessible. Covers everything from basics to advanced strategies. Also, Fidelity's Learning Center has good articles and videos on bond investing. For staying updated on interest rates and bond markets, follow the Federal Reserve's website. They publish data on treasury yields, economic conditions, and policy decisions that affect bond markets. The Wall Street Journal and Financial Times also have good bond market coverage. These resources will help you become a knowledgeable bond investor. You don't need to be an expert, but understanding the basics and knowing where to find information will help you make better decisions and avoid mistakes. In conclusion, if you're over 60, the three types of bonds I'd own are short-term treasuries for safety, intermediate municipal bonds for tax efficiency, and short-duration corporate bonds for yield. Build ladders. Buy individual bonds, not funds. Hold to maturity. Ignore price fluctuations. Collect your interest. Rebalance annually with stocks. This strategy provides stability, income, and peace of mind. It protects you from market crashes. It preserves capital. It allows you to sleep well at night, knowing your retirement is secure. Start implementing this today. Open an account. Buy your first bonds. Build your ladders over time. Your future self will thank you for the discipline and foresight. Bonds are boring, but boring is exactly what you need when you're over 60. Excitement is for young people. Stability is for retirees. Choose stability. Choose these three bond types. Choose security. That's how you invest in bonds after 60.